So, a very good morning to one and all present here in this session. I, Tanisha, would like to start this knowledge session on the topic Investing 101 for Women. So, before we begin, let me give a brief description about our organization. SEMS Welfare Foundation is a registered non-profit organization dedicated to social impact across various sectors. We focus on education, particularly skill development and entrepreneurship. Through our initiative, we created training programs in IT, finance, retail, and entrepreneurship, impacting over 6,000 individuals. So, this session is collaboratively organized by FemLeads. FemLeads is one of the initiatives by SEMS Welfare Foundation focused on empowering women, especially women entrepreneurs. It was started in March 2019 on International Women's Day. It works by engaging, involving, and empowering unity who have dreams of starting and growing their own business. So now let's get back to our session. What is Investing 101 for? Is it This session is all about the basic concepts of investing, especially tailored for women who may have stayed away from it due to fear, lack of time, or financial dependence. This idea is to simplify finance and to remove the belief that investing is only for experts, rich people, or men. In most Indian households, even today, women are seen more saver than investors. They are taught to be cautious with money, to budget, to cut expenses, and to save. But very few are encouraged to grow their money. This session is about changing their mindset. It helps women understand why investing is not just important but essential for dependence, security, and freedom of choice. We are privileged to have with us Ms. CA Swati Shrikant Godbole, who will be conducting this session. We are honored to welcome CA Swati ma'am, a highly accomplished academician, a chartered accountant, and a finance professional with over 3 decades of diverse experience spanning teaching, consulting, auditing, and research. Dr. Godbole currently serves as a associate professor of finance at K.J. Somaya Institute of Management, where she has been a valuable faculty member since 2010. Her areas of expertise include financial accounting, financial management, and direct taxation. Her teaching portfolio extends across MBA and executive programs, where she is known for simplifying complex financial topics with exceptional clarity and practical relevance. A qualified chartered accountant since 1992 and a PhD holder in finance. We are truly honored to have us with today. So let's welcome Ms. Swati to begin the session. Over to you, ma'am.
Thank you, Tanisha, for those kind words of introduction and for setting the tone for today's session. As Tanisha has already mentioned, the session is all about investing 101 for women. The way I will start my session, or the way I want to take it further, the pointers that I will be focusing upon very briefly is to start with why investing matters, especially why it matters to women per se. Secondly, we will be looking at the two famous, or two, I can say, two very important elements which always comes into picture whenever we talk about investing. That is risk and return. So we will try to understand what the risk and returns per se in the context of investments. We will also will be focusing upon the you can say the magic of compounding, what is compounding is all about, and how does it matters, or how does it help one in when it comes to investing. We also will be focusing upon, or will be looking at, what we always come across as a terminology called as allocation, or you can say portfolio management. So what does it per se means in the context of investments? And of course, something which each one of us also should keep in mind while investing is to what we should not be doing, or as we say, what elements or mistakes we need to avoid. So the session will be continued in the initial 45 minutes, and at the end of it, the floor will be open for the questions and answer from your end. So let's begin, and I will share my PowerPoint presentation. Okay, so as I was saying, the session is on investing 101 for women. The way I want to work it around is in such a way that at least at the end of it, all the women around will feel at least empowered, as you will gain some financial knowledge about it. So let's start with it. The very first thing that comes to my mind when I'm talking about on this session is why does investing matters for women? And you all will be surprised to see the very first reason that comes into picture why it matters for women is because of the longer life expectancy. Yes, all my friends, the woman, as per the report of 2023, okay, the life expectancy of women is 3+ years more than male. And as a result of that, you will understand that it is vital, very, very important that due to the longevity, the woman definitely will need more money for with them. Therefore, it but natural that we all need to have smart investing decisions or smart investing avenues with us so that we can very easily take care of our retirement years. So apart from the longer life expectancy, which is one of the basic reasons that we all women should be investing, there are other reasons also, such as career interruptions. All you will agree with me that many a times due to the family responsibilities, it is the woman, it is we the woman who has to take a career break or as a take a chance or take a break from our careers or maybe a shift from a full-time job to a part-time job or something on a different lines and levels, and that reduces or affects our earning potentials. Another reason because of which definitely we all need to focus upon investing is, of course, inflation. I'm not saying inflation only matters to women, but it's a common factor that highlights why investing is a must. Inflation always reduces what we call it as the value of money. Probably what you could have purchased at 1 rupee today, down some years, probably you may have to pay 10 rupees for buying the same elements. That's the effect of inflation. And so if someone wants to stand or fight inflation and yet to have the same standard of living what one's enjoy, then in that case, definitely the inflationary effect needs to be countered for or needs to be accounted for while taking investment decisions. Another important aspect which always comes into picture is that if we women wants to really have truly want to enjoy the independence or to have the independence or to be able to take our own decisions, then it is a must that we must be financially secure. A financial security gives all of us a kind of a confidence and allows us to take or make choices on our own terms. And therefore, investing matters for all the women across all the strata. Sorry. So, moving further, so what we have to therefore do or look out for further, and how do we take care of these all different factors? So let's look out for the very first basic thing, because investing can be done by all of us, but smart investing, if somebody wants to do investment smartly, then definitely one needs to have clear understanding about risk and return. So let's see what does risk per se stands for. So what is risk? Now, when you say risk, it means the basic, you can say basic fundamental elements that comes into picture is when you are investing out your money, then definitely you're putting the money in some or the other form of an instrument. And so the returns, that means what you will earn out of that, carries a kind of we can say, element of potential losses, quite possible is the situation is such that there can be losses on account of volatility in the market due to inflation, maybe due to the changes into the government policies, or maybe something like a pandemic scenario, which is totally unexpected for. So every investment avenue that we talk about always have some or the other type of risk associated with it. The risk is mainly on account of the uncertainties that are connected or that are related with any investment avenue that we select for. We can all can take a lot of precautions while investing, but risk is always associated with it. Say, for example, because of a risk scenario, somebody decides not to invest at all, but let the money remain in the bank account as it is. There is a lot of things that probably can go wrong in such kind of an attitude. Point number one, keeping the money in the bank account in itself results into no growth. And without growth, you cannot talk about financial security or financial independence. You need to have growth or you need to make your money grow. Now, for that growth, I cannot keep the money simply into my saving account. Even keeping money simply into saving account is not going to help you out to fight inflation. And therefore, we definitely need to take out the money from our bank accounts and need to invest it out. So, whenever we talk about investing into different avenues, each avenue that we will select will have some or the other kind of risk associated with it because of the very nature of the investment instrument that we select, because the investment instrument is getting exposed to the market, or because there are government policies, and so on and so forth. So that is the risk associated with it. So probably on one hand, it definitely my money, I'm expecting my money to grow for, but in case of any kind of eventualities, there is a likelihood that value, that growth may be lesser than my expectation. And that is what is risk is all about. When it comes to return, when we say returns, what returns typically means is, let us say if I have invested 100 rupees for a period of 1 year, then down 1 year, the money that I'm going to get back, if I get back instead of 100, I'm going to get back 120, then the 20 rupees, the difference is what typically is referred to as to be the returns. So the growth that will happen in the money that we have invested over the time period for which we have invested is what we call it as to be the return. Now, the returns can be labeled by different terminologies. You might have heard about the terminology such as dividends, interest, etc. Now, this dividend, interest are the terminologies or the indicators or the names that are utilized for this excess money that we return back because of the investment that we make. You might have also heard about something called as capital gain, which is also another way of understanding the returns with respect to a typical types of investment. Say, for example, if I go ahead and I invest into an instrument such as equity shares, if I do that, and then when in future I go ahead and I sell my equity shares, then in that case, the returns that I will be generating are typically can be referred to as to be a capital gain scenario. So returns in simple words is nothing but the excess that you're going to receive back as a result of you investing your money over a period of time. Okay, so that is risk and returns. Now, risk and returns always goes hand in hand. So whenever we are talking about investments, whenever we are talking about investing, one cannot ignore the risk and return connected with that. So whenever the investment decisions has to be taken for, we always say that be careful or be clear about what is the risk and returns that are associated with this form of investment. There is also another thing that you will come across in the financial words or in the financial news, a word called as trade-off or risk return trade-off. Now, what is this risk return trade-off? It's nothing but typically risk return trade-off is nothing but that the kind of instrument that you're selecting for investing will bring about returns to you, and vis-a-vis to the returns, it will also will have a risk associated. And therefore, generally, you will observe or you will see that if you have selected an instrument which is giving you higher returns, then along with the higher returns, there is always a higher risk. A simple example, probably sometime back, I talked about equity shares. So if you are investing into equity shares, which over a period of time, let's say a period of time of as long as say more than 12 months or maybe more than 2 years, typically is expected to give you higher returns as there is always growth in it. And 2 years is a good long period to give you good return. Of course, the equity shares, that means you are talking about an instrument which is exposed to the security market. Now, because it is exposed to the security market, along with equity shares, though I may expect higher growth, comes the volatility of the market. And this volatility, that is the changes that will happen into the security market, into the stock market, comes with its risk factor. And the risk definitely, because it is exposed to the market, the equity shares as an instrument, the risk is of a higher level. So the risk return trade off, what do you mean by that? Is the higher the returns from an investment instrument, you need to remember that the risk that you are exposing yourself is also going to be high. Contrary to that, or as a you can say as another example is if you look out for fixed deposits as another alternative investment instrument, then probably you all will agree with me that fixed deposit gives us returns which are comparatively lower. For it all will depend upon the tenure for which the fixed deposit has been maintained. Say if you go ahead and keep a fixed deposit for 3 months or 6 months or 1 year, then the rate of fixed deposit, rate of interest on fixed deposit differs. So the returns comparatively, in comparison to equity shares, the returns are lower. At the same time, the risk is also lower. So that is what is the trade-off that we always talk about whenever we are referring to investment or whenever we have to take our investment decisions. Let's move ahead and see. Okay, so therefore, probably you can take away as you can see on the screen, a key takeaway can be that if you want to be successful or want to do some investment successfully, then definitely you need to have a clear understanding about this risk return trade off. At the same time, another important aspect which also comes into picture while investing it, what is the goal? What are your objectives? What are your intentions because of which you want to do investment? So whenever investments has to be done for, one need to have a clarity about the goal. So we will discuss about this a bit in a later stage. So let's move ahead and see more about the risk and return. So what I was earlier referring to, I think this particular slide will make it very clear. So if you see on the left hand side, we are talking about a lower risk and a lower return kind of a scenario. So it's a equation that if you say that I don't want to, say for example, if I am somebody who is not comfortable taking higher risk, then we typically call such scenario to be a scenario of low appetite investor. So someone who doesn't like to take higher risk are typically are called as the low appetizer risk takers. On the other hand, the higher risk appetizers are the extremists. So whenever it is a low appetite kind of a scenario, the typical product that one can go look around for is fixed deposits, maybe recurring deposits, or maybe somebody can go for investing into the bonds which are issued by government of India or let's say by RBI, or maybe you can look around for public provident fund as an investment instrument. These are the investments instruments which typically carry with them the low risk, low return kind of a criteria. If somebody doesn't want to go for a low risk, low return, but want to focus upon moderate or is comfortable with a moderate risk kind of a scenario, what we call it as a balanced growth kind of a scenario, then they can look around for mutual fund as an instrument, a very good instrument whereby which gives you returns and at the same time helps you to create or build your own wealth. But remember, there is a moderate risk along with mutual funds. Also, very simple to understand why the risk increases once we move from FD, fixed deposit, recurring deposit to mutual fund is because mutual funds may not be directly, but even they are indirectly exposed or are connected to the security market. In the higher risk and higher potential, I mean, when we talk about higher returns, then higher risk is always the case. And in that basket, you will see elements or instruments such as equity shares. You will see elements such as your cryptos that we are talking about today, a lot about it. You may see something called as an alternative investment instruments in the form of REITs or maybe in the form of investings. Okay, so those products are of a higher risk and higher return and risk scenario kind of a case. So one need to have this clarity as to where do I stand or where will I be classifying my own self, whether I'm one who is ready to take moderate risk or am I somebody who is not ready to take risk at all, or I'm ready to take a higher level of risk. According to that, you can decide, or according to that, one can decide to select a product. Again, what I mentioned earlier, this is what you will be your path, or while making an investment options, this is how you can go ahead with your path. Now, what I'm trying to say here is, though I've already talked about risk and return, what I'm over here trying to focus upon is you need to have the goal. You need to have a clarity about an object or a goal as to why do you want to invest? What is the purpose for which you are trying to invest? Say, for example, I may be currently wanting to do an investment because down 1 year or maybe coming, let's say May 2026, I want to travel abroad. Say, for example, just as hypothetical example. So May 2026, which is like today we are into September 2025. I hardly has got, let's say, some odd 6, 7 months in my hand. but that is my wish. And if I'm wanting to travel abroad, and this is the time zone that I have, which I'm talking about 6 to 7 months, then the goal is a short term kind of a goal. And for this kind of a short term kind of a goal that I want to accumulate the money, then which will be a better option for me? So, what I'm talking here about is each one of us has got our goals, our objectives, our intentions with which we are doing investment. These objectives can be short term, can be mid term, or can be a long term scenario. Long term in the sense that today I'm working, but down the some years, maybe the minute I will attain my age of retirement, post that there won't be any workflow, there won't be any money flow, and therefore I may have to plan for my retirement, which is kind of, you can talk about kind of a long term goal of yours. Another long term goal of yours can be like today, you are in your 20s or your 30s, or you just got married, and therefore you are planning for a child. And so the minute the childbirth will happen, there itself the childbirth and connected necessary steps that we have to take for will require you to have monetary, you should be monetarily strong enough at that particular point of time. Again, another thing that will come into picture is the child's education, and so probably you may have to make arrangements for that. So in short, what I'm trying to say is that there are goals. So each one of us first of all need to find out or identify the goals that we have. Some goals maybe which is will have the which is, as we say, can need to be achieved in a very short time of period zone, whereas certain goals may be something that are longer in nature. Then, according to that, you need to select the particular investment avenue. Just as based upon my experience, whenever we talk about mutual fund as an instrument, mutual fund can be looked at from both for a short-term scenario basis also, as well as for a long-term kind of a objective also. Short-term, how can I make use of mutual funds? So under mutual funds, we do have something called as a liquid mutual funds as a you can say as one type of instrument which is available. You can make use of the mutual fund, which are liquid mutual funds, for your short term requirement. Many a time we see people investing into fixed deposit. Is there anything wrong in that? Answer is no. But when we are talking about investing, we also need to remember that the whole sole purpose behind investing has to be that I want to grow my money, and thereby I want to create wealth for my own self. So if you're having this goal in your mind, or this clarity in your mind, that I want to create wealth or want to have maximum of wealth with me, creation of wealth, then in that case, you need to make a proper choice between a fixed deposit and a mutual fund, which is a liquid in nature. As there is a slight indifference when we talk about the returns that get, one can earn through fixed deposit versus liquid mutual funds. So, for a short term goal, I can look out for fixed deposit, as well as I may look around for a mutual fund, which is liquid mutual fund. Now, liquid mutual funds, apart from giving me additional returns in comparison to fixed deposit, also have this particular feature that by the name itself, it says that it can be easily liquidable. You can easily convert that into money. Now, how does that help? Many a times we see that the emergencies can be there in the family, and for that we will need money. And so we always say that for the sake of emergency, we need to have the money with us. At the same time, just because the emergencies are going to be there, I cannot keep money with me in cash form, as it's not going to grow. So therefore, we keep money for emergency purposes into bank. But while keeping it into the bank, you can convert them, or you can keep it them into a fixed deposit form, or as I mentioned earlier, you can keep them into a liquid mutual fund kind of a scheme. Still, that will help you. Now, in a low risk scenario, or low risk low return scenario, though I earlier mentioned that public provident fund is another good example of that as an option for you for investment. But of course, remember one thing, that for public provident fund, one of the biggest, I will say, setback is there is something called as a lock-in period. You cannot withdraw money when you invest into public provident fund, at least for a period of 15 years. So the initial lock-in period or block-in period is of 15 years. So though PPF, public provident fund, is a good option for a somebody who has got a low appetite for risk. But then in that case, public provident fund should be seen from the objective perspective. It should be seen as a you can say investment instrument which is going to help you out for your long term goal achievement rather than short term. So for a short term thing, what can I be looking at? As I mentioned earlier, you may look out for fixed deposit, you may look out for liquid mutual fund kind of a case. Now, in case of a scenario for moderate risk, in as I mentioned earlier, mutual funds is one of the best instrument over there. And why do I am saying that mutual fund is the best instrument is because it has got two benefits, major benefits. One, it gives you a wonderful benefit of investing as a small or starting your investment with as small as rupees 500 per month, or even at times it is even 100 rupees per month. So if even if you don't have too much of but even if you have a small amount of 500 with you, every month investing this 500, what we call it as a systematic investment plan, SIP, that is also a beautiful feature of mutual fund which will help all of us, even though I may have lesser amount as low as 500 with me. But systematically, if I keep on investing every month 500, one month after other month, and keep on doing it for years after years, still that will be helpful. It will be a good investment instrument for me as it gives me another great advantage. I will be talking about that particular thing in a short while from now. Second advantage of mutual fund is in comparison to fixed deposit, in comparison to recurring deposit, the rate of return that we enjoy on mutual fund is higher. And it has been historically been seen that you can expect a 10 to 12% returns with respect to mutual fund. At times, even this can go beyond 12%, and you may see a 15% return also on mutual funds. The mutual funds, the benefit, another important benefit which I would like to stress upon here about mutual fund is mutual funds are indirectly giving you the benefit of stock markets or share market, because we as investors, we are not directly exposing ourselves to the stock market, but it is through the mutual fund houses we are taking the advantage. So what is the advantage here for me as an investor is, let's say I am an investor, I'm ready to take moderate risk, but I don't have that much of time or that much of understanding of stock market. Then mutual fund is a beautiful instrument available to me, because here I don't have to expose myself directly to the stock market, and I, since don't have knowledge about stock market, I'm also not need not have to worry about it, because that is something is taken care by the mutual fund houses. What I simply need to do is keep investing regularly via a mode of systematic investment plan into the mutual fund, and the mutual fund in turn keep on investing into the different schemes of theirs. Now, these schemes of theirs they focus over there on the different sectors, different industries, and that study about which industry, which sector the investment has to be done are done very well by very clearly by these mutual fund houses, as they have people who are experts in this area. And therefore, in the current scenario, mutual fund is one of the very good investment instruments wherein we all women can very easily can go ahead and invest into it without the fear of losing. Of course, because it is exposed to the market, there can be some setbacks, but what one need to remember when you are investing into mutual fund is you need to remain invested for a longer duration if you want to create wealth for yours. Coming to the higher risk option, then as I said, for higher risk, of course, investing directly into the share market is the one of the most important instrument, or one of the most important, I will say, element when we talk about high risk options, and that is investment directly into the equity share. You can do buying and selling of shares, of course, provided subject to you have knowledge about the particular company where you are investing into the particular sector, you if you are aware about it. I'm not saying that one should not go for it, but I'm saying that when you are going to select equity shares, or as I say stock, that is investment into the equity shares through secondary market, then you definitely need to take care of having thorough knowledge about the company that you're planning to invest into, have a knowledge about the management who is behind the company, have a knowledge about how the particular sector to which the company belongs to is currently functioning, what are the future stands for the particular sector, are there any specific government policies which are there, which are more beneficial or favorable for this sector? Is there any way that this sector is going to get impacted because of what is happening, geopolitically, if anything is happening and if it is going to have an impact on this particular sector? See, these are the elements that bare minimum elements that one need to look out for. Just to give you as an example, we have been looking into the current tariff war that is going on, and the minute we look at the tariff war that currently is going happening in the across, which has been brought about through US changes in their tariffs, we can see that the all the Indian companies who are into export are going to get drastically affected by that because of the tariff going up. Their products are also going to go up, so the selling price is going to go up. So how is it going to impact them? And in turn, what will be the what are they doing? What all these companies are doing to give still good returns to the investors? So this is something that one need to study to decide, should I be investing into this particular company, yes or no? Then again, another option that we have for higher risk option is the, as I was mentioning earlier, real estate investment trust. But mind you, real estate investment trust is something as an investment instrument is available for higher net worth individual. The bare minimum requirement, investment requirement, how much do I need to invest if I want to go for real estate investment trust is 1 crore. And that is where RIT as an investment instrument, though available, probably is focusing only on HNIs as we call it. Exchange traded fund is another, I will put it across, is another option available where you can expose yourself to the market but still have the benefit what we have seen in the mutual fund kind of a scenario. So exchange traded funds, the functioning of them is similar, kind of similar to mutual fund. The benefit that what we have, or what I will say more than benefit, a difference between mutual fund and exchange traded funds, the way I will put it across is that exchange traded funds, they focus upon, well, you can say one type of or one sector, as well as at the same time they are also connected to, you can say, related to one particular element, or maybe connected to one particular commodity. So say for example, we all know gold as well as silver are a very good instruments for investment purposes, but buying physical gold or buying for that matter physical silver doesn't helps us out, as it has got its own disadvantages in the form of safety, security, etc. And being Indians, we are connected with the physical gold in a very different manner. And therefore, investing into physical gold is not a very smart choice when it comes to, you wanting to grow your investments or you want to grow your wealth. Rather, you can replace it out with, instead of the physical gold, you can go in for ETFs, because we do have ETFs which are focusing only on gold. So we what we say as, there are something called as a gold ETF, silver ETFs, and so you can still get the benefit of the commodity, the gold as a commodity, and the benefit out of that, because it has always been seen that gold and silver, that is the commodities, they act as a hedge. That is, they will be helping us whenever the stock markets goes down. We have always seen that the gold and the silver commodity market goes up. So in my investment plan, I have to have this kind of an adjustment, that if one goes up, then I'm sorry, one goes down, then I need to have something in my basket, investment basket, which will help me to balance it out, because the other one is going up, kind of a case. So from that perspective, you can look around for exchange traded fund. It's not that we have exchange traded funds only for gold or silver. You can see ETFs, as popularly called as, there are banks ETFs are there, meaning these ETFs are focusing only on the banking sector, and accordingly the investments are done. There can be, we can say, another type of ETFs which is referred to as Nifty 50 ETFs. So what does it that means is that these are the ETFs who are focusing upon specific Nifty 50, that is the Nifty 50 index which is there. So according to that, they work around and they invest into it. But of course, because they give higher returns, the exposure to higher risk is goes without saying. Okay, so these are the different instruments with its own risk and you can say return kind of a scenario. A kind of a comparative analysis is what I was trying to share with all of you. And this is also another way that one can plan out which investment avenues should I be looking out for. Moving further, the in the earlier session when I talked about mutual fund, I said that there is one important thing that I must talk about with respect to the very important feature of mutual fund, and that is compounding. I know for sure many of you must have heard about compounding. So what really compounding means and what the benefit of that is, there when it comes to mutual fund is, understand in mutual fund, we always say that mutual fund gives us geometrical compounding or the benefit of compounding. So typically the compounding means what? Two things which are need to be remembered. In compounding, let's say you have invested 100 rupees and at the end of year one, you ended up getting a 10 rupee return on that. Now, this 10 rupee also gets invested into the next year. So, your next year's investment is not just 100 rupees because you are investing every year 100. So, it is next year it becomes 100. Your original investment plus 10 interest that you have earned on it or the returns that you have earned on it. So, you start earning on the 10 rupee earnings of your year one in year two. So again in the year two, you will have again another earnings, even that will get reinvested back. So it is basically compounding is nothing but earnings over earnings, interest over interest is what compounding is all about. At the same time, if somebody wants to see the benefit of compounding, then it is absolutely required that they need to start early to get the benefit of compounding, to grow your own money, or as I refer to it as wealth creation. One needs to start early, then only you will see the benefit. Just to give you one small example, yeah, let's say, look out for this. And I just want all of you to focus upon and just think about it. What can be the answer for this? Like somebody who has started at the age of 25, how much is the person investing? The is 10,000 and the expected rate of return is 12%. And another one started at the age of 35, that is down 10 years. So after 10 years the investment has started, the investment has been same 10,000 rupees per month, sorry, annually, and the expected rate is still 12%. You will be surprised at the response or at the amount of the investment of 10,000 that was done, how much it turns around to. Just look at those two figures. Just because you started 10 years later, there is a difference of 65 lakh. 65 lakh. So your retirement corpus changes drastically just because you started 10 years later. Now imagine why this is happening. This is what we call it as the magic of compounding. And this is what we talk about when we say start early. So the earlier you will start, definitely you will get benefit. And of course, a statutory warning from my side that when you are investing early, you will see the benefit provided you remain invested. You shouldn't be thinking about withdrawing it from there. The minute you are going to withdraw out of it, then you will not see this kind of benefit, what have shown as an example over here on the screen. To get that kind of a benefit, you need to be remain invested. You need to be very disciplined investor. If it is 10,000 annually and I'm going to do this investment till the time I retire, then only you will see this kind of fantastic wealth accumulation for your own self. So for me, when we talk about investing, two things comes into picture majorly. One, you need to be a committed investor. You cannot be rushing out of any investment. You cannot be thinking that instant, like an instant Maggie, I will get instant wealth. No, you need to be patient. You need to remain invested for a longer tenure to see these kind of benefits. And therefore, this last line makes a lot of sense. It reads as every year you delay investing cost you lakhs in potential wealth. I hope all of you are getting hold of what I'm trying to convey here. And so please, if you haven't yet started investing, please go ahead and start investing out, even though it may be a small amount, but please go ahead and start investing out. Okay. I haven't mentioned earlier in my, the low risk kind of an option, but there is one more element that you can look into is the post office. So even in post office also, we have got various schemes. So you can go ahead with it also. And under the low risk, low return kind of a scenario, you can check for the different options, investment options available from the post offices. Okay. Another thing, okay, as you can see on the screen, what here I'm trying to focus upon is asset allocation. And I have used the word smart asset allocation strategy. Now, what is this? See, a general thing which I have observed is when we talk about investment, people keep on investing or remain invested into one kind of or type of asset class. I'm sorry to say, but in remaining invested into only one type of asset class is not going to help you out, or that will not be a good strategy per se. Is because if you want to create wealth for your own self, then it is always and always important for each one of us to break down and invest into the different classes of assets that are available. Of course, while doing this, you can, depending upon your risk appetite, can change the percentile of investment that you're going to have into the different categories. But what I have written here is a very good strategy or a very smart strategy, and someone who is young, who has just started with the career, or who might have just start may not have just it may not be a case of a fresh start for you, but maybe down 5 years into work, still you can adopt this particular strategy for your own self. At an young age, comparatively, we are ready to take a bit of a risk, and therefore I'm saying that the earlier you will start, the earlier it will be better for you. And this kind of a asset allocation will help you out. What is asset allocation? What is there in front of you? How does this will benefit you? One, I have written equity funds 60%. Now, this entire strategy is considering mutual fund as one of an important product in your investment, in your investment horizon. Of course, you can replace it out instead of equity fund. If you're comfortable and you are ready to take higher risk, you can replace equity funds with equity shares. You can do that. You can, of course, do that. Or you can still get the benefit of equity shares. Instead of being invested into equity shares directly, you can go for mutual funds which are equity oriented mutual funds. So in a strategy or in asset allocation, I will always will give a higher weightage to the equity fund or the equity shares, exposing myself up to 60%. Of course, then 25% to debt funds, because that will help me to balance out the difference. I hope all of you have the clarity that when we talk about a debt fund, the risk is lower, the returns will be lower, but it will be a stable kind of a return that we can look around for under debt fund. As compared to equity, we have a very high growth, or you can say high growth and high return kind of a thing, but then the risk is also higher. Then, as I mentioned earlier, you need to have a balancing in your portfolio, and that balancing will happen by having a 10% into gold, where you can go for gold not in the physical form, as I mentioned earlier. Again, that's my personal opinion, that instead of a physical gold, it will be always better to have gold investment into gold via instruments, via ETFs, etc. Why it should be there? Why? What balancing am I referring to? Then, as I mentioned earlier, gold is one element which helps as an hedge. Hedge in the sense, your equity markets or your equity shares can, in case of a scenario where equity markets goes down or shares market goes down, or your equity funds are not performing, then always it has been seen that the gold market goes up. So if equity goes down, gold goes up. So that helps you to evaluate, balance your portfolio. And therefore, gold should always be a part of your portfolio. And then, of course, anytime emergencies can crop up, and therefore, you should have certain portion of your money invested into liquid kind of instruments, such as liquid mutual funds or maybe fixed deposits, etc. And that should be 5%. Okay. How much should be in liquid funds, or how much should be kept as my emergency fund? Then you will see that it is always said that your requirements in terms of monetary requirements for 3 to 6 months of your expenses is what should be a good amount that should be kept into liquid form, and the rest of the amount can be invested in the other you can say elements as explained earlier. So typically, what one need to do are two things when we talk about investment, or for that purpose to have such kind of an asset allocation strategy. And that is that you need to have your monthly budget properly in front of you as to what are the inflows, what are the necessary outflows in terms of your monthly outgoings with respect to your food, with respect to your house expenses, or as we say, household expenses, etc., medical requirements, maybe medicines or maybe travel, etc., etc., and see how much are you saving. And out of these savings, you definitely need to keep aside for emergency funds as well as for the other other elements which are there on the screen. Okay. Another thing that I like to mention here is all of us need to have a regular habit of increasing our investments as our income grows. The minute we see that my income has gone up 101%, I do agree that not necessarily that my expenditure will not go up. Yes, it does happen that with your income growing up, the expenses also goes up. But along with that, one also needs to remember that with the income growing, you definitely need to increase your savings also or your investments also. So if there has been a 10% increase in my income, then definitely it is expected that I must increase my investments also by 10%. Then only you will see the wealth creation or the chunk of wealth in your hand as at the time of your retirement. Otherwise, it will not work around. Okay, so that is something I will request all of you to keep in mind, that with the growth in your income, you must also should have this. So the five essential steps which I will like all of you to keep it in mind. Okay, are these. So what all we should when we talk about investment journey. One, as I mentioned earlier, you need to define your financial goals. And these goals, always it so happens that it should be measurable. When we say measurable, in the sense that you should be in a position to estimate out how much money in terms of rupee value, how much will you be requiring for one particular goal of yours. As you can see on the screen, children's education. So how much will I need and how many years down the line I need this month? Let's say down 10 years, the money will be required for my child's, higher education. How much? So you have to capture two things here. You are talking about it today, but the money requirement will be down the 10 years. So down 10 years with inflation also coming into picture, you need to consider this factor and accordingly decide how much monetary requirements will be there. It cannot be that you're going to need, if it is today 20 lakhs, it shouldn't be treated as 20 lakhs down 10 years. Definitely the 20 lakhs will be approximately at least 30 lakhs down 10 years. So you need to account for, or you need to plan out accordingly. So define your financial goals, which is very, very, very important when it comes to investment journey for anyone. Second, find out your risk appetite. As I mentioned earlier, also, you need to know whether you are ready to take that kind of a risk, yes or no. Of course, risk appetite differs as we from age to age, from person to person, from you can say depending upon your personality also, the appetite can change. But typically, it has been observed that in your younger age, we all are typically when we are young, we are ready to take higher risk. And as we grow in our age, the risk appetite goes down. And therefore, that's why it is always said that, when you are young, you should start investing when you are young because of that. So to get that benefit of compounding, as well as with the higher risk appetite that you have when you are young, to get that benefit, you should start, early. Then start small with SIPs. Yes, of course. And I will vouch for this that in the current scenario, for all of us, and especially for women, the reason I'm saying, not because this session is meant for women, but many a times we women may not have that much of time to go through or to read and therefore understand what exactly this particular the equity market particularly means. And in such situations, mutual funds is a best alternative for all of. And therefore, one should start investing in mutual fund via SIP. And as I explained earlier, you can start with a very small amount also. Now, for the purpose of growth, yes, you can create wealth even though you started with small. So maybe that small of 500 rupees a month, you can steadily can increase it from 500 a month to 1000 a month to 2000 a month to 3000 a month. You can do that if you are very disciplined with respect to mutual funds. And mark my words, I'm giving you a I mean, vouching for it that mutual fund definitely will give you good returns. Of course, we need to review. That's the last point, though, that we need to review and rebalance. See, mutual fund at the end of it are connected with market. So any kind of a change, if you see that the particular scheme is not performing well, if you see that it is not growing, that is where you need to review. That's what is the review part. And rebalance. Rebalance means you can come out of it, but don't take out the money. You can reinvest it back into some another scheme and again continue with your SIP. That is something that we need to do for. And this review and rebalancing is a must for any kinds of investment, and especially all those investments which are market linked. You definitely need to review and rebalance it out whenever required for. We have many experts in the form of you can say financial planners are there, chartered accountants are there. You can and you should be taking their help in case if you are not able to understand it. If you can understand it, nothing like it, then please you must go and do the rebalancing whenever you don't see the growth into it. And of course, diversifying your portfolio goes without saying, which I have already talked about it the earlier slide. And when we say diversifying, that means typically we always say that don't put all your eggs into the same basket. That's the typical sentence that come across, which means that please don't put all your money into one type of investments only, but rather spread it across into the different investment avenues which are available, which means have in your basket certain investment instrument which has low return and low risk kind of a case, some which has got middle, which has moderate risk and moderate return kind of case, and some which is high risk and high return. So you should be exposing yourself across all the three levels. That is what is diversification of your portfolio mean. Okay. Next, certain mistakes. Of course, I definitely want to talk about this. These are certain common investment mistakes that one should be avoiding. Now, what are those? One, this is a typical thing that we always see, or that has been observed by me, is that okay, my friend is investing into this, so I want to invest into that. I'm sorry, not necessary that your friend and the friend's ability to take the risk, the kind of income flow that she has, you may not have. You may have your own risk appetite, you may have your own income flow, and on the top of it, you may have your own different goal. It's all about looking at what you are looking out for, what are your needs, what are your goals, and therefore please don't follow your friends or don't follow the crowd. Okay, so one should definitely should avoid this kind of a mistake. Another one, delaying the start. I have already talked about it in that earlier example, and I have shown it to you how your investment growth or the wealth creation can be drastically get impacted by starting early versus starting late. And therefore, even though you may have a small amount today, even though you may not have as high as 10,000 per month to invest for, no problem. You can go ahead with as small as 500. Even for that matter, even the recurring deposits kind of a case where you can go as small as 500 rupees. Okay. So delaying your investment at a latter stage is not going to help you out. So you should start investing ASAP. Putting all the eggs in one basket, I have just spoken about it, so that should be avoided for. Okay, so investing only into one instrument should be strictly a no-no. Look around for the different instruments available, and accordingly you should be going for. Ignoring inflation impact. Yes, one cannot ignore inflation. Inflation is here to stay for. How hard any government may try for, or anybody may try for, we have seen that over a period of time, inflation is there. Generations after generations, we have seen inflation. The only thing what differs from generation to generation is the rate of inflation, but it is there. And therefore, to fight the inflation, if we want to fight inflation, then we need to invest smartly. We need to take a bit of a risk, because only by taking a risk, a bit of a risk, I will say, that we can fight inflation. Because only when you will take a risk, you will have a higher returns, and these higher returns is something that is going to help you out to fight the inflation. So you cannot ignore inflation while you're making your investment plan. So something from my side, just look at the picture, and I think it will make it very clear to you what I'm talking here about is we women need to take charge of our own selves today. An important message which is on the second line is don't just work for money, make money work for you, meaning let money grow on its own self and give you the wealth accumulation that you are looking out for. And that can happen provided you remain invested for long tenure, provided you start the investment at an early age, provided you are disciplined when it comes to your investments. Many a times I have seen that the minute there is a need of money, people directly, immediately go for withdrawing from the investments, and then they are not going to see the wealth accumulation. And that is where the importance of keeping aside money for emergencies, etc., and planning your portfolio comes into picture. Okay, and therefore another you can say message from my side, which I have written over there on two lines. One, your financial independence journey begins with a single step. Every successful investor started exactly where you are right now, with curiosity, determination, and the courage to begin. The best time to plant a tree was 20 years ago. The second best time is today. So, what I'm trying to say is that in case if you haven't yet started, it's not late. Start it today. You can still achieve what you want. But it is the first step that must start my investment, must be taken by all of us today itself to have the financial independence that we talk about. And mark my words, with financial independence, we women then are free to take our own decision, which is very, very important in the current era. So I hope all of you have enjoyed the session. But before we move to the further part of it, I have small two polls. Okay, you can put across the answer into the chat box. So the first one is, how many of you are currently have an investment plan? So you can just write your answer into the chat box as to A, B, or C. Okay, so I'm looking out for some answers into the chat box.
Ma'am, just getting started.
Sorry.
Option
Okay,
B.
yeah, okay. Option B, fine, not an issue. Just getting started, not an issue. Okay, anyone else who's already actively into investing or maybe not yet, but yet
Not
interested
actively,
in?
but I am interested. I will start investing.
Okay, great. Okay, good. And then another question that I have then based upon now the second one that I will be asking you is this. Now this I want all of you to answer based upon this entire session that I have just now taken for. Ki your
Ma'am, gold
investment.
FD,
investment.
fixed
Okay.
deposit.
Okay, so somebody said gold, somebody said fixed deposit. Now, why is that kind of an answer? I mean, if you have 1 lakh today, why you just want to put it into only one basket of fixed deposit or only gold investment? Why you are not thinking about investing that 1 lakh of rupees across all the different? See, I understand I have given you an option, but you can select two or three options out of that. Maybe 1 lakh you can split. That's what I'm talking about, asset allocation. So you can split this 1 lakh of rupees, a part of it into mutual fund, a part into fixed deposit, and a part into gold investment. Can we do that? Yes, we can do that. It's available. Though I might have given it as an option A, B, C, D, but my answer can be that, oh, I'm not going to pick only A or only B or only C or only D. I can have a combination. That's what asset allocation is all about. I hope you understood what I'm trying to say when I asked this particular question. Okay. And so the last thing, the questions and answers, I mean, sorry, questions in if any one of you have.
Ma'am,
Uh,
actually, gold, I mean, rate is going high day by day. So
uh,
that's why I say the gold investment is
yeah, but
better.
then, yeah, agreed, beta. But the pointer is that it was there in yesterday's newspaper itself. It's almost like again gone back to that 1 lakh kind of a thing, which was there earlier. How is it going to help you out? How does it guarantees that tomorrow the gold rate will not go down and thereby probably you may have a loss altogether? So is it advisable to have the entire amount into gold? Rather, what I can do then is split it out, bit into gold and bit into something else. And that way I can,
Yes,
safeguard
ma'am,
myself.
you are saying right thing.
Yeah. Therefore, okay. Any other question, anyone of? Otherwise, I have completed from my side, and if you have questions, then I can quickly take it up. Otherwise, I have shared my Gmail ID address with you. In case if you want to connect with me, you can connect with me on my Gmail address at swatsgod@gmail.com. In case of any questions, you may want to connect with me in future. You can always. Yeah.
Okay,
Uh, I,
ma'am.
yeah. I presume there are no questions, so let me end my PowerPoint presentation with a big thank you. Thank you to the association for giving me this opportunity to conduct this particular session on Investing 101 for Women. I hope I contributed to certain extent to your knowledge, and it was a session where you could think about some investments for your own self, right? Thank you, everyone. Thank you so much.
Thank you, ma'am. Tanisha, I would like to.
So, on behalf of everyone here, I extend my heartfelt gratitude to Miss Swati ma'am for sharing her wisdom and guiding us with such clarity. Thank you so much, ma'am, for making this session not only informative but also empowering. And thank you to everyone for your active participation.